All right, what's going on, everybody? Hopefully, y'all had a good FOMC. I mean, they didn't give us much, but maybe, just maybe, we'll get the heck out of this range we've been in forever. Keep waiting. We had a really good gap down. Yeah, it didn't turn into anything, but a lot of times when we get these gaps down in the morning, we'll end up with a pin bar like this green bar here on the 9th. I had a little bit of hope for that near the open, and then, well, that hope just went away. But that would have been nice. So instead, we didn't get that. It still seems like we're stuck focused on the OPEX to get done. And then on the other side of that, maybe we can get the heck out of here, get something else going. The low end of the expected move, 64.71. So we could go down that far and still be within the range set for the week. And if we zoom out and try to catch that bigger picture, there is a bottom to this range. $6,500. So let's see what we can do with that. Let me get logged into something. Don't really have any topics unless you guys got something that you want to hit on. So thought we would do a little poking around and to see what levels we can come up with on some swing trades. We already got the idea that um, we're looking to stay weak or short, negative, not longs, into or through April, into the end of April, maybe early May. So before May OPEX, you'll want to be out of those shorts because we can turn after that. Get logged in. And of course, if we can get headlines at any time that can jack us to the upside, anything to do with the war in the Middle East calming down, the straight opening, that sort of stuff is going to cause a rip. Our shorts would get run over. But without that, if we continue to see this energy crisis expand, then these shorts should work out relatively well. All right, this is what I was getting logged into. This is Gamma Lab, and we got 65.80 for the reference price on the SPX. This is 6,600, so we would have to get through that level to continue to go up. And you can see how unrealistic that is, right? I mean, it's just trash. And yeah, the order flow has been nasty. There is nothing good on it at all. I had Jigsaw open this morning, maybe 45 minutes. I just turned it off. So any sort of upside move getting through 6,800 without headlines, we're not going to get that done. So it's going to have to be something really good. The other thing that I've been watching that can help um, with our short trades, really give us some juice to send us lower, is going to be the VC funds. These these volatility control funds have not joined into the selling. They're still holding out. Um, Back here, find that briefing. I showed this morning. That's yesterday's. Well, let me, just in case, I'll click it. But I think that's, no, that's the one. All right. So you can see the chart below and then the second chart below. This is CTA positioning and this is VC fund positioning. Now the CTAs have already started selling and that dotted line there is the zero line. So their portfolios are already turning negative and the rate of change is increasing. The line is steepening to the downside. But if you look at the VC funds, they're still holding within that zone or that range, and they were weaker back here than they are currently. So if these guys join in and we get both of these guys selling, oh man, give it up. We're going to get hammered to the downside, and that would be fuel for the fire on our shorts. So we kind of got a catalyst on each side. We just got to look to see, which way we think is going to go. Oh man, I got to repair my database on Jigsaw. I thought the contracts got broken. That's all right. It's not a big deal. At this point, I don't really care, on the short duration, what we're going to get too much out of it between now and tomorrow. It's so tightly wound. Like, look at today. It really feels like the market's waiting on something, but it can't be waiting for OPEX. It's just too far away, right? So the market today is waiting on something that very likely is going to be happening tonight. Now, I keep going back over to FX Street because FX Street has the global news and it's going to be the context that we want to look at for global economic calendar, right? It's maybe not the best thing out there, but it's what I generally use and it doesn't cost anything. Try to keep the cost down where we can. So what do we got tonight? That the market is waiting on. Nothing. So I don't know if it's not going to come from the economic calendar, then maybe there's some headlines that they're waiting on for some sort of action in the war space. It's the best that I can come up with. Maybe they're about to run some sort of attack, and it finally ends this energy crisis. Otherwise, I don't know what we're waiting on. The market is tightly wound, and OPEX is too far away It's tomorrow at the close. So can you imagine being this tight between now and tomorrow for 24 hours? We've seen that happen before. 45 or a 50-point range holding for 24 hours, but it's rare, and it would normally be in front of something really big, like when Nvidia was more connected and they was sitting out in front of Nvidia earnings, things like that. But this ain't that. So it's hard to believe that that it's OPEX. It's got to be something else, and there's nothing else on the calendar. So it's just like, well, what? I don't know. If it is something on the war front and the whole market's waiting on it, and then it comes out in the overnight, it's going to run our shorts over and it's going to be a violent rip to the upside. If nothing happens, then our shorts should work until either the energy crisis gets resolved or we get to the end of April and getting into May. Now, it's not going to be a straight shot. We're going to take pressure, and things are already down some. So I was kind of hoping that today was going to be an up day so that we could short from a green candle. I really like to do that rather than shorting from a red candle. I wasn't even looking for much, right? Just give me a little bit, but we got nothing. So I want to point out some things that we could get some shorts on, maybe even look at some options, talk about various products that we could trade. But unless we got something really good, like we find some of them in the green, I wouldn't recommend taking it yet. Just keep the bias, keep the setup. And then if we get that green day or even a green couple of days, then we can take that move. Last Friday, I started talking about these shorts. And if you had taken the trade Monday or Tuesday on those green days, you'd have been good. But the people that I talked to said, no, it turned green and I thought it was going to go up. So they didn't short it. They tried to get long with it. You got to stay on a plan, not just, react to every candle that comes up. All right, I rebuilt my database in Jigsaw. Of course, now I got to go in and change the contract. So, what do you guys think? The Mag 7 is probably the easiest target. They're going to have the better options, but they're going to be more juicy. They're just straight up more expensive. We could keep it cheaper focusing on the ETFs and or, some of the cheaper products out there. But doesn't really matter that much to me. I like what Spot Gamma does. When they want to get a short on something, a lot of times they'll look for like SMH. They use this for a proxy to short the markets. Because, if the S&P and the NASDAQ is going to go down, chips are going to go down. But if you look at SMH lately, these options are just as expensive as trading SPY. So then it's like, well, if I'm going to pay that much, I might as well just trade SPY. At least SPY is going to have more juice. All right, we're getting some acceleration in the cumulative delta. I'll put my chart in the chat and bring it up here. Look at that acceleration in the cumulative delta. Nice. It's just been climbing and climbing and climbing and climbing. Now, some of this climb is because they're rebuilding their open interest in the new contracts. And that's one of the reasons that it looks like this while we have that on the price action. But one day, it doesn't get us where we want to be. There's price. Price taking off with it now a little bit. Get you some of that then, if you like it so much. Getting up through that VWAP that we've been dancing around with. So this could give us that up move for our short play. You can see it in the cues too, right? Getting that little bit of push. Got to get out of this box. Strong push up in the ticks. We got about above 750. We need to hold them in the green. Got the weighted AD back above the 0 line if we can keep it. Got Banks pushing off of VWAP and Mag 7 pushing up through the VWAP. It's a good start. But look at the advancing minus the declining issues deep in the red. Green line pointing up. We could get an afternoon run. Speaking of afternoon runs, I'm going to get the bike out today. So we're getting off of here at 4. No dilly-dallying today. I knew I should have streamed Tuesday to cover my Wednesday, but I was busy Tuesday, so I didn't do it. If I had, I'd have been on the bike already. So let's argue out some ideas here. You could take some cheap longs. You're going to hear in a lot of stuff when we start to get this lift up about right side tail risk and taking the long side right after OPEX. We're likely going to get green, all that stuff, right? I just don't trust the green play. So I'm not looking long yet. I want to get through, well, obviously the rest of March, but through April OPEX before I start looking at long opportunities. So any move to the upside, in my opinion, is an opportunity to sell the rip, not buy the dip. So you could wait for that little bit of a lift. And if we're wrong, you could get some cheap out of the money plays just in case it just rips, right? And the only reason I really think that we could be wrong is a headline. Like I was saying, though, anything about the war, the strait being opened up, something like that, it could rip stocks hard to the upside. And that would, of course, run us over. So some kind of out of the money long opportunity, a butterfly up there, a ratio play, something that will be cheap that we could sit to the upside, and if it doesn't work, we don't even care. I mean, I don't want to lose, but when it's a really small risk to reward play, then I'm down for that. About right there. All right. So at least April OPEX, we got the cues. We're looking at big round numbers 600. Probably has a decent, oh yeah, decent open interest. Almost 20,000 in open interest and almost 5,000 in volume today. That's not bad. Let's see what else we got out there. We'll go 60. They're shopping around in the 20s. So at 620, we got almost 3,000 contracts, 13,000 in open interest. So they're putting a little bit of work out there. 620 would get us outside of that range. Need to be able to see it, or you guys can see it. It would get us outside of this box that we've been in, right? The upside of that box is down here, and we're looking at 620, which would be above all of that. So it would be a ripper, right? This ripper would only be valid if the strait is opened or the war ends or some kind of language like that that really sparks the market higher. This is not our base case play. This is like a cheap lotto just in case, right? So don't put a lot of money in this trade, whatever one you decide. I'm going to try to build a few different trades up there just to see how they price. And then we can look at the risk. I really like shorts and I want a short, but I don't want my short on this red day. So let's try 620 with a butterfly and see how much that costs. It's 4 pennies, so we can widen it out, go 5 wide, see how much. Oh yeah, it's not even 50 cents. Get a little bigger. Tasty Trade did these videos where it talked about how a wider butterfly or a wider iron condor really benefits you on your win rate. But at some point, if you get too wide, you lose its benefits and then it just kind of collapses. It doesn't have the value that you're looking for. So if I was to go 10 wide, it would cost me about $1.35. And when it comes to how wide you're making the trade, remember that the width of the strikes really matter. I'm on a $1 wide strike selection. If this was the SPX and it was already 5 wide, then 10 wide is not your limit. You would want to be willing to expand that at least 20 to 25, right? The conversation with Tasty Trade about keeping it around 10 wide as your max was a discussion on things that have a narrower strike selection. So with this 10 wide trade, we've actually got a 20-point window that price could land in. And if you haven't done butterflies beyond very short-term stuff like intraday or into the week kind of trading, then you've never experienced how these butterflies will gain value over time. I call it baking oftentimes. Like I'll just throw it in the oven and bake it for a while. It really changes the way that the options mature when they have the time to mature. If they're really short term stuff, they don't mature the same way. It's completely different. So a trade like this with a 20-point window and the time in it that it needs to be able to mature, this yellow line is a representation of the trade as it's alive. And the cyan line is the representation of the trade at expiration. So every day that goes by, this yellow line is going to slowly begin to shape into this cyan one. On this side, it's going to drop. And on this side, it's going to drop. And in the middle, it's going to start to rise. Our concern is where price is. Right now, price is all the way down here. And we need it to go this way. Now, if we start moving that way really fast, all of this is below zero. We wouldn't have any benefit yet at all. What could help us get that yellow line up is possibly volatility, but more likely price. So this gear icon right here allows us to play with the future and ask, what if? Hey, what if volatility gets really big, even though that would be odd with price going up and then having volatility also go up? but it's possible. That's what they call spot up, vol up. If volatility did go up, would it help my butterfly or would it hurt my butterfly? Well, we can turn on the gear icon, and here where it says volatility adjustment, that's exactly what we can do. We can adjust the volatility. So I'm just going to start hitting the plus sign here and watch that yellow line as I adjust it. It doesn't matter what the value is other than I'm increasing the volatility. And as you can see, that yellow line is going down. Well, that's not what we want. So we know that getting an increase in volatility would not help my butterfly, which is cool because it's very likely that volatility going down is the more likely outcome, right? If stock price rises, volatility is very likely going to fall. So let's jack the volatility to the other direction and see what we get. Now, in theory, I'm like giving this thing a vol crush. It wouldn't be this bad, but it's giving us the visual of, hey, how will my trade perform if we do get a crush in volatility, if they come in and just strip the volatility out of it? As you can see, it's benefiting our trade. I put a lot in there. We won't get that much of a vol crush, right? We just won't. But it helps to understand if we see price rise and volatility falls, this butterfly will benefit from that. Okay, cool. Now let's change time a little bit. This is an April 17 trade, and we've got March 19 right now. So let's just move it forward 10 days to the 29th. At that point, the yellow, I should have done it day by day, huh? So we could see that yellow line move. Let's put it back to 19. So I'm moving it through time, and you can see how that yellow line is adjusting because it wants to take the shape of this cyan line. That's what it wants to do. So every day that goes by, it's going to do that. Now, we know that it's going to go down here eventually, but the low is starting here and it's slowly getting lower before it starts to rise. So if you watch that tail, it was up here, it started sinking. This part started to rise a little bit because it's got to come up, right? So depending on where we are landing, right now we're all the way down here, we could see price run up, say, above 600, maybe 605. And if we're getting volatility crushed and we're getting time going by, the yellow line is very likely going to be above zero. So we'll have some profit in there. Maybe not a lot of profit, but considering we're not even in the window of the butterfly, any kind of profit would be better than no profit at that point. So, not a bad thing. And then, of course, as we get closer and closer to expiration, it it's going to get even back here, it's going to get underwater and then we'll be back into a losing position again. And lesser until we can get in that window. So here's 319. We're going to adjust this calendar so it quits turning gray on us like that. April 17 expiration. What that gray box is also showing us is the expected move implied volatility. So for a one standard deviation of the price action, 70% of the time, we should stay inside this box. We have almost a 35% chance of closing on this side of the box and 33.25% chance of closing on that side of the box. This trade, while it is a $1.40, if we just round it up, it might be a little more risk than you're willing to take. But one, you won't lose all the money all at once. It's going to take time. So you could decide to get in, and then after a week or 2 weeks, maybe you don't want it anymore, and then you get back out. There's no reason that you should assume max loss in this. Worst case scenario, maybe it loses 75% of its value. Let's see if I got that calculator on here. I got the Steam Deck and I was building it earlier, but I didn't get all the buttons put together yet. It's basically a control box with buttons on it. Take something the size of like a deck of cards. Well, no, that's too small. Take like the something the size of a an Android phone, like one of those newer Samsung phones. That's the size of the device, and it has buttons on it that you can program and change their icons and the imaging on it, and it sits there on your desk, and you push one of the buttons that you've programmed, and it does some function that you told it to do. I'll put the picture in the chat. I moved it in front of my keyboard so that you could get some um, representation of size, because otherwise, without that, you might not be able to see to gauge or judge how big it is. But put it next to a keyboard, kind of get an idea. This is one of those generic ones too. I didn't even get a name brand one because I've never used one and I wasn't sure I was going to like it. So I was like, well, I'm not going to spend big money for one of these and then find out I don't even like the darn thing. So I just bought this is like a $60 version. For those who don't know what I'm talking about, it's that right there. The buttons are whatever I want them to be. You can see here, there's the calculator button. All of the icons are something that you can choose to do for yourself. Here's the control. So like I programmed, that's my page. And this is just a generic page that was on there already. And this I programmed as well. It's just a clock with a date on it. I'm running temperatures here on the side, and I've also got like a internet speed test right there. So I can see the temperature of my computer. I can see my GPU temp, um, my streaming speed, upload, download speed. I can run a speed test, set a timer, do a 15-minute countdown or a 30-minute countdown, all kinds of stuff, right? Like there's so many things that you can program these to do. And then there's a store where you can get more for free. There's things you can buy, but you don't need to. There's a ton of free content, icons and plugins and all kinds of stuff. These are all free things. You could just, you don't like the way the icons look, then you can do your own. You, yeah, kind of neat. Now I love my smartwatch, but I've always wore a watch and I sleep with it. Do you sleep with your watch on or do you take it off? Yeah. See, my wife, she won't sleep with a watch, but she will sleep with a ring. So we got smart rings. That way she can sleep at night and still get all her sleep data. Me, um, I don't know the company name for the rings that we got. They're not the expensive ones. They're just really generic because I wasn't interested in getting something that I would break easy, and hand tools, everything else. So I got cheap rings, but Apple watches, nothing cheap about them. That's for sure. I'm telling you, I'm getting to the point where I'm about done with them. I'm so frustrated with them. All these different companies out there have AI. Apple does not. Apple has Siri, which is a complete idiot, and she's basically going to fetch you Google results and then tell you, here's the link if you want to click this and go to that Google result. So no AI. They're locked down when it comes to what you can download, what you can install. Has to only be Apple Store approved. It's There was a scammer that hit me, tried to hit me for $100, and they blocked it. Well, now I try to buy anything from the App Store, my bank denies it. Everything from the App Store, everything. Security. Yep. I'll tell you, with Apple, everybody complains about how expensive their stuff is. The thing is, if you buy a brand new one just once, from that point on, every year when they come out with something new, you can upgrade and it's going to be like 150, $200, at least for people like you and me who probably, I'm sure you respect your devices. I'm making an assumption there. We respect our devices, we don't beat them to hell. We don't work in nasty environments where they get easily screwed up. You'll be able to cash it in, and with an extra 150, maybe $200, you can just every year stay on the latest device. It's not expensive to keep up, but oh man, the first shot, $1,800, $2,000. And if you're like me, you can't get one for you unless you're going to get one for her. It's funny, me and my wife, when we go out to eat, we sit side by side in the booth and we prop a phone up while we're waiting for our food. We prop it up and we watch like cat videos or whatever. People eyeball us like crazy. But, as soon as food gets there, then we put the phone away and, but we sit side by side and watch things together. That way we can talk about it, laugh and share because we're out to eat together. We want to be together, not individually on our own phone. Yeah. Yep. I watched. I didn't see where it was coming from at first. And then when she got down and whacked him, I'm like, yeah, okay, I got it. I got it. No, all good. So we were pricing a lottery ticket to the upside just in case they open the straight or they call a quit to the war, which is, in my opinion, the only risk to our short trades is one of those two scenarios. Otherwise, shorts should be good into at least April OPEX and probably closer into the May timeframe. So I like short trades. I'm hunting for shorts right now, like trying to balance out my deltas, but I like shorts and we were just pricing in just some cheap stuff, just something that'll get us into like 620 SPY. If you don't like, or 620 in the Qs, if you don't like the Qs, then you could choose SPY or something else. Keep the price as cheap as you can because these are 100% pure lottery tickets. And we don't want to put a lot of money into a YOLO. And that's kind of the idea behind it. All good. I was thinking, yeah, yeah. The where's the beef is what I keep thinking when I look at this. That and those old ladies in the Facebook commercial, the ones like, that's not how it works. That's not how any of this works. SMH was a good proxy for a while, but SMH's options are getting so expensive that it's not even becoming a good proxy anymore. I always like XLF for anybody in the much smaller accounts. If you're wanting to keep it cheap and still participate in the move, XLF is always a great choice. It's less than $50 right now. It usually has decent options. So if you're in a smaller account, you want to find smaller products. What I find a lot of people do is they try to stay on the big products with a small account and then they try to find really cheap stuff. You can handicap yourself so badly doing that even a trade that should be a good trade ends up losing because you had to go so far out of the money to get it cheap enough, or you had to make the trade so small like a butterfly that the bullseye was almost impossible to hit. So if you got a small account, one of the things that you can do to really help yourself out is find smaller products to trade. That's tricky because we don't want just smaller, we also want liquid. XLF, it doesn't always fit that liquidity bill, but it's not bad. It's certainly something to keep on your radar. Um, State Street bought Spider. These used to just be the SPDRs, right? But now they're owned by State Street. And for the most part, they're not bad. You got the XLI, XLF, XLK. We used to just call them the XLs. I don't know. I haven't heard anybody call them that in a long time, but that's what we used to call them. So you can shop around. XLB is another one, much less liquid. But depending on the kind of trade that you're going to do, it's not that bad, right? Like if you're just straight up buying a call or buying a put, then this liquidity is okay. It'll get you done. You know what I mean? It's $38 to buy a call. 38, you don't even have to make it into a spread. You could just buy the call. I don't want to lose, but when it's $38, you don't even need to defend this trade. You can just buy it, throw it out there, and if it makes money, close it as a winner. If it doesn't, walk away and leave it alone. Who cares, right? Don't even waste the effort in trying to close it. So since we're looking at potential lottery moves, some big thing happenings that turn it around and go the other way, on a down day like this is the day that I want to shop for those upside lottery tickets. I don't want to buy them on a green day. I want to buy them on a red day like today. So if you look at XLB, we're down below $50. $50 wouldn't be a bad target to the upside. Not bad at all. And it's not like we're asking for very much, right? So we could come in and we could look at April 50 strike. It is $37, $38. Work the order and pick that up. If you wanted to go a little farther out, because both of these have some open interest, then you could try the 51 strike and pick it up for probably 24 pennies, maybe 25. Got to, split the mid there a little bit. 24. I'd work that order, see if I can get it a little bit cheaper. The other one has more liquidity, right? It's been traded 500 times today, and that's why its bid ask is a lot tighter. As soon as somebody starts trading this afternoon, it'll tighten up, and you could grab one of those or a couple of them, right? Don't no reason to stop at one. Just remember that these are low probability trades. So don't size up, don't put a lot of love in it because they're probably going to lose. Inevitably, somebody's going to say, "Oh, I'm putting on a hedge." It's not a hedge, right? It's not a hedge. It's just a lottery ticket, like going into a gas station and buying a scratch lotto. Now, you could also do something on the other side, like you could do a short on the put side, short put vertical. This $47 could pay for two of these 52s and maybe have enough commission to cover some of the trade. But now you're risking both sides. You'll need the market to stay above that, and you would need the market to potentially move high enough to hit these calls. I'm not a big fan of this because we're putting these on as a YOLO. We're expecting the market to go down, so we don't want to pay for these calls with a short put, but it can be done that way. Maybe if we had a different bias, we could. So shop around, find the product that you like for an upside move. You're basically throwing darts at the barn. It doesn't matter what you hit as long as you're not messing around with energy or commodities. Stay away from dollar yield commodities. You should be fine, right? Anything else, if they resolve the war or open the Strait of Hormuz, we should get a solid rip to the upside, and that'll pay these lottos off. I find it very hard to believe that they're going to resolve the war or even get the strait open. So that's why we want to continue to hunt for shorts. There is energy plays. Um, the refiners aren't doing so bad. They're going to get whacked if that strait gets opened. So if you did want some shorts to play a lottery, just like we're buying the long calls and cheap things, we could look for cheap puts in the energy space. Anything that's doing really good now would be a short, but still just a lottery because we're not expecting the war to end or the strait to be opened. So just kind of keep that in mind. And I don't think any of these are going to be profit. Yeah, see, they're expensive for a small account. They're expensive. They're way cheaper than SPY or the Qs. And of course, State Street has XLE. It's more generic, but there is that route. $60 as a stock. Getting into that power hour. I took a reversal earlier um, off these highs, but other than that, I didn't get anything. My pre-market was good, but once the bell rang, I haven't had anything because I don't want to do anything when we're in this range. I used to get really excited about iron condors and things like that on these range days, but I've really backed away from that. Now I'll run like a short vertical against the high or a short vertical against the low, something like that, and then potentially leg in to an iron. But these range days are big risk because at any moment we could get that explosion that brings us out. Like the market's waiting on something. The, I remember I was having a little bit of a struggle with the after hours trading in the futures as well. And um, I started using my Bloomberg, listening to them talk because I do that in the mornings because you wake up in the morning and trying to figure out what happened while you're sleeping. And in the evenings, I wasn't doing that. So I started doing that in the evenings, just like I do in the mornings, and everything changed. To see in the evenings, um, Australia's already open and they're waiting for Asia to come online. So on Bloomberg, they do the Asian Bloomberg session, and they're talking to people, they're interviewing, they're giving you the news. Different companies over there are talking about earnings and how good everything is doing, and you get this vibe for how are the Asian markets going to open? Are they bullish? Are they bearish? Are they cautious? And it really affects what's happening on the ES and the NASDAQ in the after hours charting. So, yeah, maybe a little bit of both. The In the evening, I've been at the computer all day, so I'm in the frame of mind to be trading already. So I'm not thinking that maybe that's much of it, but it is giving me their bias on the morning. Because I could tell you, like, the Nasdaq would be coming down into a low of the Globex or coming up into the high of the Globex, and I'm like everybody else trying to figure out, okay, we're going to get to that high. Are we going to break out? Should I short that high? And if I'm listening to them talk and they're exuberant and they're talking about earnings and everybody's in a positive mood and you can just hear them talking about the Asian session before the open, just like they do here, and it's all positive, we're likely going to break that high and go higher. Or if we're at the lows and they're really positive, we're likely going to reverse those lows and then bounce off the lows and come higher. So XM radio, they have um, a Bloomberg channel, and it's different than if you was to go to the free Bloomberg radio that you can find on, like, various websites, and even in Fidelity's got a Bloomberg. Theirs seems to have a delay in it quite a bit, and then they don't have they'll just cut out and play music for a little bit, and then they'll come back, and then they'll cut out and play music and come back. So it's not the same as XM radio Bloomberg. I was talking to somebody last week, and they were saying that Bloomberg has really expanded into YouTube too. I haven't poked around over there, but if we had someone asking about the XLB, I was poking around on XLB building materials. Let's go back over there and see if I threw it into the analyze tab. No, that's the Q's trade. For the XLB, come on, Thinkorswim. What'd you do? Freeze? You turd. Okay, so we want April. Out of the money, the 51 or the 50 strike. And it's just how much are you willing to risk? The 50 strike, I like it better because it has more liquidity on open interest and volume, but it's $10 more expensive than the other one. And $10 doesn't sound like much, but if you're in a small account, you might not want to risk that 10 extra dollars. So the 51 strike would be your better choice. I would not go farther than that, right? Like, leave 52, I really don't like, and 53 on down. These are all bag holders, so you want to stay out of all of that trash. Look at these guys, $2.13. This is one person. No, look, open interest is zero. There's not even anything left there, except for this one. Those probably got traded the other day. Surprised they're still on there when it's zero interest, but bag holders. Corn, it's very hard to find a good corn trade that has any liquidity whatsoever. What are you going to use for corn? Well, like, DBA is a good ag play, but even that, there's just no liquidity there. So I'm wondering, how are you playing um, grains and corn? Because there's the futures, but you're gonna have to get a specialty future broker for that. And I seriously doubt you have, on what though? Options on what? Where are you going to get corn? Oh, gotcha, gotcha, gotcha. So yeah, I'll second that. When I bring up a stock, I want to see that it has weekly options. If it does not have weekly options, 9 times out of 10, I walk away right there. I do not go any further. If it all good. There's no wrong way to trade when it comes to options because we can do just about anything we like. But I'm risk averse. As funny as that sounds as a trader, I gauge everything by its level of risk. So when I look at anything, say like corn, and I think, should I trade that? It's illiquid. I'm going to slip a lot of money to get in and a lot of money to get out. And you don't feel that slippage, especially if you're new. You just don't feel the slippage. But it's 25, 35, $55 to get in of slippage. That's just pure loss. And then another 30, 40, $50 to get out. So well over $100 one time. If you do that all the time, then you're slipping constantly. Then there's the other side of, can I get out? If it starts to go wrong, will I be able to actually get somebody to take this off my hands? And if it's in a vertical or a butterfly or an iron condor, it's going to be almost impossible to get filled to get in, which leaves you buying long calls and long puts and then trying to get out of those. These are institutional playgrounds. That's why you'll find large open interest on a couple of strikes and everything else gets ignored. Look at these NA, NA, NA. Nobody's trading it. Nobody wants it. That's a hint. You don't want it either. So we can use these options, especially as a stock trader. If you own shares and you want to protect those shares with these options, perfect. It has enough liquidity for that. But if you want to speculate on the price of the market going higher or lower and think that these options are going to deliver the value, nope. They're very likely going to just drain you uh, a little bit at a time, and just bleed you dry. So you got to try to lean into where there's edge and value, and there is no edge here, no value here, especially for a small account. Yeah, yeah. It's cheap enough because it's less than $20, so it fits for the idea that you could do that, and it's a single, right? Like instead of a long call or a long put, you'd be a short call and short puts, and you could do those single legs, so that's viable. And from a stock point of view, defending, not really defending, but getting rid of your shares with the calls on the other side of the wheel makes perfect sense because you don't have to fight getting out, right? You sell the put and you can ride it all the way to expiration, either banking on your profit or getting assigned and getting your shares. So certainly viable because it does bring in that stock aspect and it keeps the trade single leg. That's doable. What a lot of traders do with options, though, is they use them to trade, right? Like they buy the call because they think the stock is going up. They buy the put because they think the stock is going down. And a lot of times these options aren't very expensive, which is good to see. But a lot of times it'll be a $5,000 option. And that means if your stock is $100 and you buy, an option that was $50, you need that market to make an extra exaggerated move just to see your option hit profit, like hit break even, let alone start to see any profit. Take Nvidia and look at the cost of these options. This is a $10 option at 175. So if I bought this option, what's my break even? 185. Just for the option to get to where I could start making profit, I would need Nvidia to first make a $10 move from 175 to 185. Anything above 185, I would start to see profit. It has a $16 expected move, so 10 of that is going to pay off the call. The other 6, if we made that move, would start to show me a little bit of profit. So that's a lot of risk, right? What would I get for a $10 move? I would make $700. Actually, I wouldn't make anything, right? Because I'd have to give that back. Above that, then I could start to make a little bit of profit. But look at that $10 move. It didn't even pay off the debit that I spent to buy the darn thing. So this is where newer traders get caught up, and Nvidia is considered liquid, right? Take that same argument and apply it to something that isn't liquid. Now you're screwed. And a smaller stock will have less strikes. So a lot of times you're forced into trading exactly what the institutions are trading. With corn, for an example, you got 2 strikes. That's really about all you have to play with. But there is a style for every kind. You can't form fit aggressive price action into anything that you want to trade. Make a set of rules for your options trades. It will help. My rules say no weeklies, no speculating, meaning I won't buy a call or a put. I will maybe wheel or, I'll do something else, but I won't just buy options for a run. No weeklies, no speculating. Weeklies is not the only sign of liquidity, but it's a good start. Fertilizers also have an issue because of the Strait of Hormuz. Let me get my notes brought up here. Um, I just went over this with somebody because we were looking at the energy play, and there's an energy fertilizer play going on right now. So, the whole energy crisis with the Strait of Hormuz and closing down the global. Okay, so fertilizer fits into that same category because of how much fertilizer comes through that strait. Dude, that would be so cool, right? Your carrots look a little blah. You just give them a 5-hour energy boost. Not a Red Bull though. We don't want our corn to get wings. So CF, check those guys out. Huh? Even after its last earnings, it broke that previous high and really started to get. Now it's weak, but it had to come down and get that gap closed, which it did. It got the gap closed. And so now we're stuck in this what if or what now situation, right? We got weak to get this gap closed. Now we got to run back up and continue that expansion to the upside. And there's still gaps down here that need to fill, but this is our situation right now. So we can run a mid, capture that high down to there. You can see we're struggling with the mid right now, and we are turning red, green, red, green. Oh, look at that. Higher for longer. So if you guys have been around for a while, you may have heard me talk about the Embers project. It's been around for a long time. I first came across the Embers project in 2018, and it was like 4 years old at that point. So last month, I got curious and I reached out to AI and started asking AI about the Embers project. It is predictive analysis of human behavior. Things like, will there be a riot? Now, it can also do things like, will there be a measles outbreak, or, will there be a flu outbreak, influenza, blah, blah, blah. But riots are what really got my attention. This thing is able to predict human behavior, including riots, weeks in advance, and tell you the street corners of where that riot is most likely to break out in the time frame that it's going to break out in. And it is very, very accurate. And that was back in the day before we had AI and quantum computers and all that neat stuff. So, if you want to have a fun conversation with AI, ask it about the Embers project and how AI has transformed that project and how more accurate it is now compared to what it was then. It's kind of scary how they can anticipate human behavior. And of course, here's my science, not scientific, my psychology side adding fuel to this. If you know the ingredients for a particular behavior. Say you want to set someone off and have them punch a wall, and you know just how to push their buttons to trigger them. If you know how to push the right buttons to be able to anticipate human behavior, then you know the same buttons that you can push to cause a specific behavior. Do you want riots at a particular street corner in a couple weeks? I got you covered. And you just go in and you use your fancy tool. That includes any behavior. Voting, everybody talks about voting. How about they just choose the kind of voting outcome they want? Not because they're going to go in and cheat the machines, but because they can just wind people up. It kind of just sounds like some tinfoil hat stuff, doesn't it? My brain went on a fart cloud when you asked about that other company, and it's right there, and I can't grab it, and yet it's quoted all the time, right? Like it's on every news outlet quotes them now. I hate that. Here's another outlier to the upside. This is PBR. It's another energy company. But if you look, they had already been doing good, right? We were in this base for quite a long time. Let me bring it up onto a weekly. There is an old market phrase that says, the longer the base, the higher in space. You should take that with a bit of a grain of salt. This base wasn't as big as some of the better ones, but it went, from April 2025 into, we could say January of 2026, but it was this last low in December before it started to run, and now it's on the run. Now we got the broader box. We just run it back here, and we had a breakout of that, and PBR is still going. Not the beer, right? PBR beer. Shouldn't be drinking that, by the way. So look at that run. It has a very sharp move to it. It is likely that this stock is going to also take a beat down when the news comes out about the straight and everything else. But it's important to remember that this stock was already making its move before the war and the straight and all of that impacted us. So the limit to this might be minimal, right? That it might not take a significant beat down. For the leap question about longer term trades, I tell you, there's a really fun trade that you can do, and it's good for all kinds of scenarios. It's worth learning this one trade, and we've talked about it before. I'm going to use PBR for this just because I think it's going to be a great example of this one trade. Suppose you like a company or a stock over the next 18 to 24 months, and you want to trade it long, but you have to be realistic that just because we buy it doesn't mean it's going to go up. It might go sideways for a while. Heck, it might even go down for a while, right? And it might stay down and then never go up at all. So we can't just buy the stock. We can't just buy the long call and walk away. We need to know that we can protect our trade or defend our trade once we're in it. And that's what this trade does. So you pick your poison, pick your product. I'm going to use PBR, and we're looking at least next year because we want to focus on options that are like a leap. So 2027 January, if they have 2028 and you've got the capital, you could consider this. If you're in a small account, don't do this. And it's important to say that because in a small account, you need to keep turning over capital, right? You can't just park your funds in one trade and then sit on your hands for 2 years. You have to keep that money in play. This takes the money out of your hands and it's in one thing and you can't do anything else. Inevitably, you're going to get bored. You're going to want your money back so that you can trade something else and you're going to close it. And that defeats the purpose. So just if your account's really small, don't tie up your capital like this. But if you've got the capital and you're not going to miss this money, it won't hold you out of a trade and you'll continue to be able to look for others, then this is a perfect trade. So I've got January 2028 at the money call, less than $4. Granted, this is a cheaper product, it's $20. So if we was doing this in SPY or the Qs, this would probably be $50,000 or so. It's going to be quite a bit of money. But you pick your product. So if I bought this call, I don't want to lose $400. But I've had, restaurant bills higher than this, bar tabs, things like that. It's not going to break the bank. So I buy this, but I want to know that I can defend this trade, that I can protect it. So we buy it and we just forget that we own it. Don't even look at it again. Because what we want to do from that point forward is we're looking for a long stock. We want to see it rise. And if it's not doing that, if instead it's going sideways or even worse, it's going down, then we're selling calls against that long that we own. And we can sell calls naked. Technically, they're not naked because we have that long call. But on the front end, where we are selling, we only have to do the sell side. We don't have to, like, build the short vertical like we normally would. If I want to sell that call, then I would need to, buy a call. And that way we've got a short and a long. You've already got the long. All you have to do is add the short. Now, instinctively, when I show people this trade, they say, oh, well, that's $400. I don't want to lose $400. So I'm going to go way out of the money and I'm going to buy this one that's a lot cheaper. Don't make that mistake. The one that you buy is going to dictate the ones that you can sell. So you need to be able to sell something that has enough money to make you money. If I buy this 30 strike call and I want to now sell a call in the front end, here's the 30 strike call that I could sell. And I could sell that one or any of these um, farther out. So 30, 35, neither one of these have money. If I sell any of these, like the 22, I'm going to have to cover the $8 difference between the 22 strike and the 30 strike. I'll have to cover that with margin from my account. It's going to tie up my capital. So if I bought a 20 for next year or 2 years out, I could sell a 20 or I could sell a 22, 20, I could sell any of these. So the one that you buy is going to dictate which ones you can sell. Buy the one that's at the money. Heck, if you can afford it, buy the one that's in the money. You're going to try to make your money back by selling calls against that long call that you own. It allows you to be long over the next 2 years. And in the next 2 years, your only job is to make that money back. In this case, I would need to make back $350. That's like the midpoint of this long call, right? 350. So I've got a year and a half or 2 years to make $350 back. So no rush. And since I got it at the money or in the money, then the calls that I do sell, they actually have some credit to them, right? I don't have to worry about nickel and diming selling a 10-cent call and trying to make 5 pennies off of it and pay commissions. There's actually a little bit of juice here. That is the perfect trade. You can also take the other side. Say, in something like SPY or the Qs, and you think, I really believe in the next 18 to 24 months, we're going to have a radical sell off. Don't know when, not sure. Maybe they're going to call the president lame duck and shut him down, and they won't let him do anything, and they cancel his tariffs, and everything just goes to poo. Great, buy a put. Well, if you haven't shopped around and looked at those puts, they're expensive, especially if you go out for a year. So here's January 2028, so about 2 years, close, at the money, 60.29. So it's not as bad as I thought. $6,029, right? Maybe I need another zero on there. Yeah, 52,000 in profit. The max loss $6,300. So 6,300 is what you would have to buy, right? $6,300. It's not that bad. I was thinking 60,000. So that's the SPX. But that's a lot of money. You don't want to risk $6,000. Not unless you know you can protect the trade, right? So you go out and you buy that put, and for the next 2 years, as long as we continue to rise, then you're selling puts to pay it off. Now, granted, I picked an expensive product, but it could have been anything, right? Take a look at, like, it doesn't matter what it is. Look at something cheap and look at those puts that you could buy a put on. And if we don't crash in the next 2 years, it doesn't matter because you've been selling short puts against it, paying it off. All right, now that is a completely different discussion. The question is, well, what about something like the SQQQ? These are something completely different. What you want to be careful of when it comes to this sort of thing is what they're designed to do. This is not a buy and hold product. You're supposed to get in, make your move, get back out. They were never designed to be held. And every day it just goes lower and lower and lower and lower until an event happens and then it spikes and then it's lower and lower and lower and lower. Right? That's all that it does. It's all it's designed to do. So you could day trade these, jump in, jump out. You could maybe hold them for like a Friday expiry kind of thing, but holding on to them into the close and then into tomorrow's open means you hold it through its reset, and it's a double or triple. Some of these are doubles, some of them are triples, and they're just designed to lose value and lose value and lose value and lose value. That's all it's supposed to do. So you don't want long-term trades in anything that's double or triple leveraged at all. Those are a really dangerous, bad idea. ONDS. Got some decent strikes. We got weeklies, uh, some participation, not very expensive on the strike selection, $5, 50 cents wide. I like that. The cost of the options for the value of the stock is a little high, but not enough to make us turn our nose up, right? That's not too bad. You can see the participation is decent. I I don't I don't see anything really bad with it. And look at that. Wow. I got to say that number's a bit surprising in a good way. I'm surprised to see 185,000 contracts traded today. I like it. Looks like they've been hitting um, pretty equally here, 30, 30, and 30, between at the money and slightly out of the money and really out of the money. That's where they've been setting up. Nice. Let's look at the stock on that. ONDS. Yeah, close to earnings. So March 25 next week. And we want to trade either into earnings or out of earnings. We don't really want to trade the earnings itself. Trying to trade the earnings itself is like going to Vegas and putting it all on the roulette wheel. So, because of that, you want to go beyond that. Let's say we're bullish in this. We would want to use options that go past this earnings by at least 6 weeks. Then we want to think about what we've been talking about. How is it going to be affected with the war and the Strait of Hormuz? If the strait gets opened up, what will it do to this stock? If it stays closed, what is it going to do to this stock? Because the longer it stays closed, the more everything is going to suffer, and our energy crisis is going to get worse. So much worse. Airlines are already having problems with personnel. They're also now having problems getting jet fuel. One of the Asian nations reached out to China and begged them for fuel for their airplanes. And China just straight up told them, no, screw you. We're holding on to every drop we've got. We're not sharing because we're having problems ourselves. So, how badly is technology going to get whacked in this situation? And you kind of want to think that through because it won't matter how the stock looks, right? Like the midpoint here and whether we can break above it or not. It won't matter how good the options are. what's going to matter is the outcome of this war and the Strait of Hormuz and how quickly that gets opened up again. That's going to be the number one thing to be thinking about for any trade you put on for the foreseeable future. You'll want to take every stock that you're looking at over to AI and say, hey, I'm looking at this stock. What do you think is going to happen to this name and its peers, its sector, its industry if the strait opens, if it doesn't get opened soon, if the war ends, if it doesn't end soon, so that you have a good idea. Remember, not just the stock, but what space it's in, what industry, what its peers are, all of that. So I asked AI about ONDS. It said it raised capital in January 2026 over $1 billion. The company is aggressively scaling through its acquisitions and high value military contracts. Sounds good. Operates through 3 primary units, autonomous division now driving nearly 99% of its total revenue. Not so good. All of its revenue tied up into one spot. Current growth engine focuses on AI powered drones and ground robotics for defense and critical infrastructure. They have the Optimus system, which is an FAA certified, fully automated drone. And they have the Iron Drone Raider, which is a counter drone technology. So, as long as the war continues, these guys should do pretty good. Yeah. But with that in mind, why are they down? You would think with the war kicking off that they would be doing pretty good. Oh, in the last 2 weeks, they acquired BIRD, which is an Aero Systems missile protection system. They bought the Rotron aerospace propulsion system and the INDO Earth Moving Military Engineering Vehicle system. They are manufacturing defense drones in Germany for the European and the Ukraine markets. So I didn't get an answer on the war. I reached out to AI and I'm asking it that question too. What's the projection for war and why is it underperforming? The $1 billion offering was a massive round, and that did give them a boatload of money, but it was significant share dilution. That's what caused this smackdown. And now you got to be concerned that they're going to do it again, right? Buy the rumor, sell the nose. ONDS skyrocketed 600% in the last 12 months in anticipation of a Middle Eastern conflict. And now, well, you've got Operation Epic Fury, and traders are taking their profit. So they were already bidding up this name in anticipation of the war, and now they've got their war. They're also deeply unprofitable with a projected net loss of $53 million for last year. In a high interest rate Fed pause environment, the market is punishing growth at all cost stories. And that's what these guys are known for, growth at all costs or at any cost. It says, crazy enough, if the war ends, this thing's probably going to go up. So now you have the answer to that. Which side should this fit into? We know oil will go down if the war ends. We can play that, right? With this, AI says, oddly enough, it probably goes up if the war ends. So that's what we've been saying about those lottery ticket long trades, like the cheap butterfly that we were looking at the start of the stream. Anticipate this doing the same thing. You would only want to look for a long in this if you think the war is going to go to an end soon. Cool, cool. Remember, it's not about the stock price per se. We always want to look at the stock, right? What the chart patterns are telling us. Is there a signal, a setup, something we like? Always. But we got to think about, why is the stock going to move? What's going to bring them in? What's going to run them out? So, so at least you got a pretty good idea that ONDS at this point will be the same kind of trade as Apple or Microsoft or SPY or the Qs going long if the war ends. Otherwise, it's likely to get hung up and or suffer like the rest of them. And I don't like getting that trade in front of earnings. When we go to trade into an earnings, it would be when you're like 6 to 8 weeks away and you make a run into that earnings, or you let it report, and after say 8 to 10 days after the report, then you trade out of that earnings. What I don't like to do is look around at what's reporting in the next 3 days or next week and then get into a trade to trade that. I'm not interested in those. If you're looking to short energy names, you should give it enough time for the war to end. Now, taking a short in these is going to be very much like taking the long in SPY or the Qs or anything like that. Um, and we've been aiming for those for April, not May. No, on the one hand, this war could go on for years, right? I mean, look at the last time we were in the Middle East. But with oil, I misspoke. I should have said how soon the strait will open up, not how soon the war would end. We could be at war for the next 10 years for all we know, right? Exactly. So I know I don't want to see us in another 2-decade war. I do not want that in any way. I don't care how much the markets could profit from it. The strait should not stay closed for very much longer. I'm thinking that April is the right option expiration to use for shorting oil or for lottery ticket long trades long. Because after we get into May, I think normal longs should work and normal shorts should work for XOM. So normal longs in SPY or the Qs once we're into April, once we're into May. But before now in May, any longs in those would be lotto tickets, and any shorts in this would be lotto tickets. So you could use April contracts for uh, CVX, XOM, just shop around for April because we're looking for, coin toss, something really cheap, lottery ticket, hope it works. And, you throw it on there like scratching a gas station lottery ticket. These are not high probability trades, right? Taking a short in XOM, coin toss, gamble, trip to Vegas. Taking a long in SPY, coin toss, gambling, trip to Vegas. there's no play there, right? Which is why we want to pick something really, really cheap. Otherwise, shorts are the way to go, right? Take Amazon, Meta, Apple, Google. They're shorts, right? Here's Amazon with that really nice low. I don't want to short it today because I don't want to get into a short on a red day, right? That's why we were shopping for the long lottos because I'd rather take a long lotto today and look for a longer term short for a green day, right? When I mentioned this on Friday, we had the move up afterwards. That was our time to get some shorts on in those two green days. Not now that we've got two red days. That's my style though, right? This isn't about right or wrong. I'm not saying you're going to lose just because you get into a short trade on a red day. That's not true at all. It's just I don't like getting short on a red day. I want to get short on a green day, and I want to get long on red days because I try to get as much edge as possible out of my trade. Look at the way the options price when we're bullish. Everybody's buying calls. The cost of those calls get even more expensive, and your requirement to find success gets pushed farther and farther and farther out. It makes it harder and harder and harder to be profitable. But you get one red day in a whole week of a green days. That one red day, the cost of those options will turn in your favor enough that you can buy calls without the handicap. It's a much better trade, right? It's not to say that you can't lose anyways, because oh boy, you know, trading isn't about not losing. It's just making sure that when we do lose, we don't have to take outside losses. So today, being a red day, we're shopping for those lotteries, something really cheap in case they open the straight and the market shoots to the upside. Last Friday, we were talking about taking those longs or taking those shorts. All we needed was the green day, and you had those 2 days right there to find your short trade. And we're still looking for the same targets, right? So 200, 195, 190. That's the play. Well, for Amazon, that's the play. Okay. Thank you. And for those, you could use April, maybe May, depending on what you're trading. Just let liquidity point you in the right direction. So take Amazon here. I've got May and I've got April. I don't like, see what we got. Nice open interest on the April. Looks really good. May's decent, really. I mean, that's decent. June's too far out. I said it was too far out, but actually, look at that. They're spread out all over in Amazon. That looks good. Maybe, what about July? Okay, July is too far out. You can see how we're in triple digits, one strike that's really getting some love, but otherwise, it doesn't even come close to what we were looking at in these others. But I like April or May for a nice short. I know I'm looking at the call side, but calls are a good representation of risk right now rather than the puts. So as I said, you're going to hear a lot about right side tail risk in the next 2 weeks or so. So if we're looking for shorts in Amazon, we want that green day, not red day. Get that pop to the upside and look at these open interest 5 digits long. looks really good. You can almost see the volume profile in there, right? Where it's thin and then it widens out and then it gets thin again. That I wish that this platform was new enough to have that sort of a visual in there. But there's your structure. You got decent volume. They're not crazy expensive. That's silly cheap. So we'll run this. Come on. What is with Thinkorswim today? I still use it way more than I should for my analysis, but I've got so much hope that TradingView this year gets it over the hump. They started it last year and it's looking good. If they can pack tasty trades options data into TradingView the way that I'm envisioning, it's going to be so awesome. We won't have to use Thinkorswim anymore because you'll have all that options data right there on TradingView. But until then, I'm going to do my analysis here. I think you're going to really like trading at Tasty Trade. Yeah, have you watched any of their webinars where they did a walkthrough on the platform? And you can request 1 week of paper trading. Well, it's so that it's for pushing buttons, right? It's not so that you can, prove your strategy works or any kind of trash like that. It's so you can push all the buttons without breaking anything or accidentally filling trades. Because it's better now, but they had a very unique dome, very unique, and there was no way you could get used to trading it except to trade it live, and that sucked, right? Because it was just like something you've never seen before, and they're like, here you go. Well, how do I use it? You'll figure it out. What, with money? Yeah, I can't figure it out on paper first. I made this butterfly $15 wide. I might have gone a little too wide. I'm willing to back it up a little bit, but it's $1.27. Amazon puts with 180 as the midpoint. It's for the April expiration. So up here, we want to make sure we're on April. And we can see I'm overshooting the expected move a little bit, but it's the downside. And if we do fall out, like I think we're going to, then we should easily be able to make that leap, right? Like we would fall fast if the fall does come. So, kind of thinking that that's acceptable. Um, let's take a look at Amazon with the dealer positioning. Someday, if they'll get around to it, maybe they need to have a moment. My goodness. All right. Well, they're not bringing up dealer positioning, so we'll have to turn it on here. Not sure about turning it on. Normally when it's because it didn't log me in. Fine. I should be logged in back here. Nope. That would explain why it wasn't bringing it up. Let me get logged in. There's the dealer positioning. All right, so the dealers are just barely getting long, and that means the retail or everybody else is just barely getting short. It's a green day, at least on this. So why it's green here but not on mine is because it opened at 207.15 and it's gone up to 208 something. So technically it's a green day. It's higher than where it opened, but it's lower than the previous day's close. That's why on my platform it's showing as a red day. If we close lower than where we closed yesterday, then it's a red day. So I like that it's getting short with the dealer deltas, and I like all of these tech names for a short, unless the war ends or the straight opens. So yeah, just looking for a good green day, maybe a 2 green days in a row. Get another lower high and really break this low. Notice we did get an equal low. Not quite sure what I like about that or not, but and it's not to the tick perfect, but we did get that equal low. I like this short play. Um, whether we're going to go to 200 or if I'm overreaching with that 180, I'm probably overreaching. We could back it up and use something that's not so far down, or we could add a leg to this and point it to the upside. That way, if it falls, but it doesn't fall lower than this, then, up here, it's still good. We would need a short put vertical for that. And that would mean adding, what did I have? Adding another 95 and an 80 on there. So we'll just do it here. Uh, add that and that. Nope, got to go the other way. There we go. So this is pointing it the other direction. We're still red. We would lose $50 or 50 cents on this side. But if we hit the middle, then we're good. And if we overshoot the middle, then we're in loss. I think it's too big. If we're going to add that, I would make it smaller. If we're not going to add that, then $15 wide is probably fine. Are you still playing with Hood? I thought you were done with Hood. We've got this bear flag, and the flag part is extending far enough that it makes me think it's not actually going to turn into a flag, right? It makes me think we're going to get a failed flag and come back up the other side, which would form a really big cup, maybe a handle, and then, an extension on that cup. But we're in a base right now. And we got to get out of that base. Hollow red candle. That means it did the same thing as Amazon. It gapped down here and then it ran up today. Got the gap closed. So at least it did that. But I'm not seeing any edge in trying to take a swing in this. Day trading is good. I mean, there's nothing wrong with catching a day trade in something like this if you can get some moves. But yeah, I had a decent open. Day trading this, There's nothing wrong with it at all. Absolutely not. Um, Trying to take a swing trade in it is where I wouldn't mess with it. Just because when I look at it and I think, what do I want to trade? I want to trade something that's got some edge to it and something that I can fit into the narrative of what's going on with the straight and the energy crisis and all of that. Well, when I look at this, I have no idea how it fits into the energy space or the war and the Strait of Hormuz and any of that stuff. I don't know how it's being affected by AI. There's just so much I don't know about it. And then to look at it in the middle of a range for a swing trade, I got nothing. But if you was to trade it every day and you know how it's being affected by AI and you've already talked to it about how it's going to respond when the straight opens up and you got all that figured out, why not? I know a couple of traders who are still trading like XPEV and Neo and those things just because that's what they like, right? There's nothing wrong with it. Rivian was moving this morning. I didn't do anything with it, but Rivian had that Uber news today. Oh, it washed it right back out. Nice example of a liquidity gap getting washed. That would have been a nice short. Yes, sir. Yeah, can do. I I'm hoping we get that green day tomorrow so we can start those shorts. I think that'd be fantastic. But yeah, I'm with you. I think this is a good place to wind down, call it a day, and we jump on the morning briefing tomorrow. Maybe look for a green day so that when I stream tomorrow afternoon, we are ready for some short trades. It's very possible. There's a lot of concern about how much open interest there is. This is a really large OPEX. It's not historic breaking, I think. That was like last month or the last OPEX, but there's a lot of money moving out on this, and we have to be concerned that they're going to wash it. But just have to see how we open. That's why I'm not in a Friday expiration trade on SPY right now because I just don't know how we're going to close on Friday. So if I did, I'd already been in it. I'm hoping for a green day tomorrow so we can add to those short trades. If we don't get it, we can at least examine the short trades like we did last Friday because we did get that Monday and Tuesday to the upside, which for anybody who was looking for them, that was your chance to get short. So hopefully we'll get another shot at that tomorrow. That's what I got, guys. Between now and then, if you have topics that you want to cover, things that you want to hit up on, stocks you want to analyze, really anything trade related, hit me up. I know that all of the moderators really appreciate that. So, don't hold back. If you got a topic or an idea or a stock, we'll take a look at it. Other than that, let's wrap it up and come back and do it again tomorrow. Yes, sir. Have a good one. Later, everybody.